Market news now. Asian markets were mostly down, with Chinese markets declining as investors digested key Chinese economic data. Hong Kong markets led losses, with the Hang Seng Index tumbling 1.25% in the last hour of trade. China released a slew of key economic data. Industrial output for November was up 3.8% year-on-year, better than the 3.6% expected in a Reuters poll. Data also showed that retail sales in November rose 3.9% year-on-year, below the expectations of a 4.6% poll that was conducted by Reuters. Looking at what's happening stateside, the Fed will conclude its two-day policy meeting later, and the central bank Fed chair, Jerome Powell, is set to speak at around 2:30 Eastern time, which is 9 p.m. South African time. The central bank will release a statement with quarterly projections for the economy, inflation and interest rates. Jerome Powell will also hold a press briefing at that particular briefing. But to give us an update on how the markets are going, and I suppose also look back at the year that was, we are joined by Michael Traherne, who's from Investec Asset Management. Michael, thank you so much for your time. I mean, between me and you and various other market commentators we've had over the past couple of days, today is actually the last sort of working day before everyone heads off into the holidays and then comes back in early Jan. But a check-in on our local markets. How are we faring right now, given that we're waiting for Fed Chair Jerome Powell?
Good afternoon, Nastasia. Markets opened red this morning, but I'm pleased to say that we're currently up 0.6%. Unfortunately, our currency hasn't been had as good a fortune. The rand looking rather weak at the moment at 16.22 to the dollar and at 18.27 to the pound. As you said, though, Fed Chair coming out with the interest rate decision this evening. More importantly, though, will be their forecast on changes in interest rates and also their bond buying levels. What will happen there will be driving the markets, particularly given that it's a change in interest rates and it's a change in money supply in the US, which is the global currency. So expect ripple effects across the market this evening.
When you look back at the year that was, what would you say surprised you the most?
I think it was the fragility of our supply chains. We're still sitting in the case where there's many ships stuck at sea trying to get into ports. The chip shortage that we're seeing globally that's impacted car prices, the impact on commodity prices, because countries have rebounded from COVID a lot quicker than original forecasts. So I think it's a reminder that everyone is so intertwined with everyone else that these sort of once in a lifetime or once in a generation events can have a far-reaching impact.
So yesterday in our conversation with our market watcher, we were talking about how some analysts are of the view that there's a lot of noise in the markets and that one has to look out for specific signals in order to see where things could be going. What signals are you looking out for in order to try and ascertain as to where to from here?
Yeah, I think I go the opposite direction and I intentionally tune out the noise. Where we are at the moment is noise. At Investec, we're very long-term holders. We're in it for 3, 5, 10, 20 years. I promise when most people are selling their shares in retirement, Omicron and Delta and COVID and anything else that's going on at the moment will be long gone, forgotten. So it's about finding quality companies that you feel that are going to grow faster than global GDP for the next couple of years and putting money in it. The rest is just noise.
China was a theme this year, and one interview that I did, somebody said everything that could go wrong in China happened to go wrong. And I'm curious, from your point of view, do you see things happening the same way going into next year, or do you think that things will be a little bit different?
I think the Chinese government will calm down a bit. I think to put things into perspective, this year the Chinese stocks were doing really, really well until about March, when the Chinese government stepped up regulatory pressure on all their big multinationals. And that spooked the markets. There's also the way that you get exposure to a lot of Chinese companies is through quite elaborate international tax structures and holding structures, which with the stroke of a pen, I suppose, in Beijing, those structures could collapse and you would lose all your money. So there is that very big risk factor, and that's what we saw come to play with Chinese stocks this year. I think it's going to be a while before the market has eased to those risks again. I don't think that will ever go away though. But given the fragility at the moment around their property sector, I think the Chinese government probably won't be rocking the boat much. Also, let's not forget they've got an Olympics coming up, and they want that to be the focus, not any other political sideshows.
So as a portfolio manager, investing amid Omicron, where are you seeing value?
Yeah, again, I think we long-term investors, so we're not worried too much about short-term moves. In terms of value, it looks like your very SA Inc. type stocks have been sold off more than needed, assuming that Omicron is very mild and that we stay off these red lists. That'll help a lot. We also need our resource companies to do well. When we're looking internationally, your fintech companies have been hit heavily because they rely on tourism. So those are two of the sectors that we're looking at. But in general, quality companies are quality throughout the cycle. It's just sometimes you get them on a discount, and when they're on a discount, you need to jump.
Before I let you go, what do you think will be the biggest risk going into 2022?
So I think risk in terms of volatility will be inflation and interest rates. It's the current story busy playing out globally. I don't think that goes away next year. The market's in two minds. Is inflation temporary or is it here to stay? I'm of the view that it's temporary and it'll fall behind us. But if it's not, we're going to see very high interest rates, which is not good for growth, not good for stocks. But so let's see what happens.
All right, Michael, thank you so much for your time. That is Michael Traherne from Investec.